Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So today I have with me Kent Ritter. He is with Hudson Investing. How you doing today, Kent?
I'm doing great, Lance. How are you?
Good, man. Yeah, happy to have you. Yeah, we've been trying to get Kent on the show for quite some time. So excited that we finally got everything lined up and making this happen. So, why don't we jump right into it? You know, I'm always interested to kind of hear how people get into this business. I think it's helpful to kind of hear that, origin story. I mean, what drew you into the real estate space, and how'd you get your start, and what ultimately kind of led to the formation of Hudson Investing?
Yeah, no, I appreciate that. So to go back to kind of the beginning for me for real estate investing, it actually started with another business in a completely other industry. I started as a management consultant and spent 12 years in a career doing that. And in 2010, actually started a management consulting firm, a little boutique firm with several partners. We ran that through 2015. It grew tremendously to 95 employees and $30 million in annual revenue. And then in 2015, we decided it was time to exit. So upon that exit, I had capital and I didn't know what to do with it. I knew I didn't want all my eggs in one basket in the stock market, but I didn't know about alternatives. So I started exploring, started doing research. Long story short, that led me to real estate as what I thought was the best option for many reasons, and started investing in real estate, started just trying to educate myself, started out as a passive investor, actually, in syndications, because I knew that there was a lot that I didn't know. And I thought that passively investing with others would be a great way to learn. Yep. So in 2016, I went out and I invested in 10 deals passively with several different sponsors. And in doing that from about 16 to 19, along with 2 mentorship programs, and just consuming all the books and podcasts and everything that I could, and going to about 10 to 12 conferences a year in those several years, just really build up a wealth of knowledge to the point where, in the conferences, I felt like I knew what they were saying. I knew what they were talking about. I wasn't hearing new things, and I really had confidence that this is something I could do myself. I mean, just coming from my consulting experience of leading large-scale projects and large-scale change management initiatives, and having to get a lot of people rowing in the same direction and manage these multi-million-dollar projects, I felt I was well suited for real estate. Because that's essentially what an apartment syndication is. It's this large-scale project where you have multiple teams and multiple groups with different incentives and different goals, and you have to get them all going in the same direction. And if you can do that, you can be successful. So that was really the culmination of me starting to become an active investor. I developed over that time this passion for real estate and just this understanding of how real estate investing can change people's lives and can build wealth far beyond what your traditional means of your 401k and even stock market investing can do. And when my eyes were open to that, it was like this light bulb went off, and I was like, wow, this is something that I want to do as really my second career, right? As I was looking for what that next step is, and saw this learning about the syndication model, and that you can just pool money together, right? We can all invest together to go and buy a bigger and better asset than I could on my own. I mean, just clicked for me. It just made so much sense. And I was just off to the races. So in 2019, partnered with some folks to complete our first syndication. And we're actually selling that property. Really, it's the middle of June right now. And this week, those 2 properties will sell, and they'll have an amazing return. And so I've got my first deals going full cycle. And then through that, I've completed 4 other syndications through 2020 and the beginning of 2021. And so we are really just now rinse and repeating. We have a strategy that we believe in, and it's just about sticking to the plan.
Yeah, no, that's a cool story. So yeah, I mean, I think it's very appropriate because many of our listeners are sort of in the position you were in back, after you guys exited the business, right? Sort of, okay, alts is a thing. I've got some cash, I want to invest it. Maybe you can share with us sort of what was like your biggest aha, or like the thing that when you began to explore it, I mean, especially, making 10 different investments with multiple sponsors and sort of, right out of the gate that, I'm assuming you sort of had to develop, you developed a process, but what were the things that, like, what advice could you give to somebody else as they're looking, or what were the big, like I said, the ahas for you? It's like, you know what, I thought that this one thing was really important, but I realized that I really need to be asking this question, or I really need to worry and focus more on this other thing.
Yeah. Well, there's like 3 or 4 that just come up right away, but I'll start with, just from a strategy standpoint, just when you're thinking about, like, when I was in that point where I was like, I know I need to have this money invested. I know I don't want to be in the stock market. Where else to go, right? Because there's thousands of other options. I really started to focus on, what were the things that were important to me, right? So I think you have to start with, like, what's your investing criteria? And for me, I wanted something that wasn't correlated with the stock market. I wanted something that allowed me to have both income and appreciation, right? And those were 2 of the main factors. And then that kind of led me to real estate, and there are a couple other investments. But when I got in, so starting with that, I think is important. What are your goals, right? What are you trying to achieve? And then as I got into real estate, so all I really knew about real estate investing at that time was, well, if you invest in real estate, it means that you go out and you buy a single family and you become a landlord, right? Because that was anybody I knew that was investing in real estate, that's what they were doing. And so that's what I originally had in my head was, okay, I'm going to go out and buy properties and I'm going to manage these properties, right? Well, I had some mentors step into my life at critical times along this path to get me to where I am today. And that was one of them, essentially. And it was really, I guess, less of a mentor, more of a friend. But, I have a friend who owns 30 or 40 rental properties. And I just noticed as I'm talking to him, and like, and when we would go and get beers and hang out, it's like, man, he doesn't really sound like he's enjoying his life. Like, he's managing all these properties and making money, but like that, it's a full-time job. It's a lot of work. It's like what they say, tenants, termites, all the toilets, all those things. Right. And so I was like, okay, well, that doesn't sound like the approach I want to take. And at that point, a mentor had come into my life, who owned multifamily and really guided me in the direction of, well, you should really look at multifamily for a number of reasons. And then the plan was, okay, multifamily, great. I could go out and maybe I'll go out and buy a 50 unit, right? So I'm still going to manage myself. I'm still going to own it and manage and go buy a 50 unit, right? But at least I'm in multifamily. Well, I had another mentor come along through some discussions and say, well, what do you do then? Right. I'm like, what do you mean? I'm going to have that property. He's like, yeah, but all your money's gone. All your money will be in that property, and you're kind of back to the same place, and you have all your eggs in one basket. Right. And so I'm like, okay, well, what should I do? And that's when I was introduced to syndication and the idea of syndication. And that's when the light bulb really went off. And it was really like, wow, this is incredible. One, I can start to invest with people who know more than me and have been doing this for years, right, at the beginning. But also it's a way for me to be able to go buy bigger and better assets myself. So I set down this path to always knowing that I wanted to do it actively. It was something that I wanted to pursue as like my quote unquote next career, but being self-aware enough to know that there was a lot I didn't know and that there was a lot I didn't even know I didn't know. And so that's why I started off passively investing first to try to fill those gaps. And the other thing I did was hired a couple of mentors, right, who were way farther down the path than I was. And a mentor focused on syndication, mentors focused on real estate in other areas. And I was able to use those as kind of a backstop and as a way to continue my education, but also as a way to avoid some of those costly mistakes that somebody who's starting out will inevitably run into. Right? Learn from others versus repeating the same mistakes.
And when you have that, right, so it's like, okay, it's like a bit of that kid in the candy store sort of moment, like, okay, syndication, this is great. Okay, I can diversify. And now you've got, you start to look at the world differently. It's like that reticular activator system. You buy a red car and all you see are red cars, on the road. Or
That's right.
so,
That's right.
This is what I've found, right, is that it's great, and you sort of realize it's there, and then you start paying closer attention to it, and you realize like, wow, there's all sorts of options, and it's sort of noisy, and all these claims that people are making, and we're doing this, and they're bullish on that market or this property type. I mean, in this case, multifamily. I think a lot of people start there. It's a bit easier to get your mind wrapped around how that works. But so how did you, because I think you're in Indianapolis, right? Or you're in, yeah.
That's right.
So did you sort of start local then too? Like even like narrow down your search to like, okay, who are the deal sponsors or the syndicators in Indianapolis? Was it like Indianapolis multifamily, or how did you sort of narrow it down to even figure out who you should be, talking to?
Yeah, well, no, I actually took a different approach. I wanted to be diversified across different geographies as well. So I did find sponsors in Indianapolis through local connections, but also through just going to conferences and just listening to podcasts. I found other syndicators. And so I wanted to pick syndicators that were in different geographies to have some geographic diversification as well. And so, but in Indianapolis, there's a firm called Burge and Held, who I started out as a passive investor with, and then actually joined as we created a partnership, and we partnered for about a year and completed several syndications. And so that was a way where I was able to transfer from passive to active. And now I'm at the point where I'm able to set out on my own and complete my own deals, and really just, again, kind of this stepping stone from passive to kind of active with support and partnership, and now active, being able to run the whole process completely on my own.
So now that you've kind of made that shift, what is your sort of buy box? Have you formed sort of your investment philosophy, right? And just, that thesis, I guess, or what I call strategy, right? It's you have to have a strategy, and there's no necessarily right or wrong answer. But for you now with Hudson, what does that look like for you guys?
Yeah, absolutely. So it's a little bit different than what you're going to hear from everybody else, right? In that we are focused on acquiring small to mid-sized multifamily properties, and small is relative, right? What I would say is that's 150 units and less primarily. So about 30 to 150 units, small to mid-sized properties in the Midwest that are undervalued. I mean, at the end of the day, I'm a value investor. I'm looking for properties where there's a value play. And what we're finding are properties that are mismanaged or undercapitalized and therefore undervalued to the market. And the Midwest, the reason why we're in the Midwest, one is, I'm local here. I have a hyper local knowledge of the area, allows me to be in markets and have relationships that folks that are flying in are not able to have. That have been built up over years, but also just the Midwest it's a better relative value than other markets. If you go to some of the hotter markets in the Southeast and Texas and Arizona, the cap rates are low and continuing to go down. And in the Midwest, relatively speaking, our cap rates will be anywhere from 50 to 100 basis points higher than those other markets. So you still are able to have a relative value, which is extremely important when you're looking at cash flow investing. And so for me, it's really cash flow first. And then I believe that over time, appreciation will come. Right? The appreciation will come as long as you're in a market that's growing, that has good job diversity and good job growth. That appreciation is going to happen, but it's that cash flow that allows you to weather those storms. And so I would much rather, again, come in, buy a value property. We're looking for properties that have a story to tell, right? There's a deficiency where we can come in and we can solve that problem. And in solving that problem, we create a ton of value.
So in particular then, are we talking like Columbus and Indianapolis and Cleveland, and what are those?
Yeah, well, exactly. So right now I have properties in Indianapolis, in Louisville, Kentucky, in Lexington, Kentucky, and in Dayton, Ohio, and then we're just really filling in around that area. So Indiana, Ohio, Kentucky are primary markets. Also looking in Tennessee. But really, if you think about kind of a radius around Indianapolis, staying out of Illinois for budget and property tax reasons, but yeah, just looking for solid properties in secondary and tertiary markets in the Midwest where there's high demand and good job growth, and where we know that we've identified some reason that we can come in and provide immediate value.
Yeah, if you wouldn't mind, let's talk about some of those markets in Kentucky. I feel like, for most people, familiarity is pretty low, maybe, which I think is probably, why it's a good place to sort of be looking. So maybe give us a little bit of more color on,
that's right,
Lexington and Louisville and, what it is about those markets and, what they have and, kind of why you like them.
Yeah. Well, the first thing I'll say is if you're an active investor, like they're terrible, stay away. Don't go there. But if you're looking to passively invest, then they're fantastic markets. No, they're all, the reason that I like them is they share commonalities with Indianapolis. So Indianapolis has, for instance, it is the city, county, and state seat of government. So there's a lot of government jobs. There's a really high percentage of healthcare jobs and higher education jobs. And then there's a huge logistics base there. Like Indianapolis has the second largest FedEx facility in the world located there. So there's, if you think about jobs that are non-cyclical, right? Government, healthcare, higher ed. And then if you think about jobs and industries that are growing, well, logistics, right? And there's a lot that's coming together in markets like this. So I like markets like Indianapolis, right? At Columbus, Ohio, very similar, large university, right? Again, a lot of job diversity, a lot of government. And if you think about somewhere like Louisville, Louisville is the North America headquarters for UPS. So they have the North America headquarters there. Yep, they have. And then if you think about along the highways that are connecting the Midwest, Indianapolis is called the crossroads of America because you can reach, the stat is something like you can reach, I think it's 80% of the continental U.S. within a day. Right. And so that's why there's so much logistics located there. And so all along the highways around there, you have your Walmart distribution centers, your Amazon distribution centers, all of this it's bolstering a lot of these tertiary markets around these large cities as well, because a lot of these exist along those highway routes. So just from a growth standpoint, and just the type of jobs that are there, because really when you're looking at multifamily, the most important thing is the jobs. I mean, people live and move where jobs are, right? And that's why you choose where to live. You either choose where to live because it's by where you work or it's by where your kids go to school. But primarily it's by where you work, or at least you have easy access to get there. So getting back to that, Louisville, it's got a lot of good things going on there. Lexington is very similar. I mean, in Lexington, just the demand for properties is extremely high. Again, if you think about University of Kentucky's there, right? They've got a big education base. They've got a lot of other good industries going on. And even if you're going up to like Cincinnati and to Dayton, Ohio, I mean, we're just seeing a lot of growth in those areas. I mean, as there's manufacturing coming back to the U.S., there's a lot of small manufacturers on those highway corridors, and we're seeing good growth. And the thing that's lacking in a lot of these markets really is clean, affordable housing. So, there's a lot of properties in these areas that were built in the 70s and 80s that are just undercapitalized. Their owners don't have the money to put back into them, right? They're long-term owners. And those are the great buy opportunities. When you find a long-term owner, maybe a mom and pop owner, kind of has run it on the side, doesn't have the money or desire to put the money back into it to renovate and keep it going. But many of these properties are 100% occupied, right? Because they haven't kept up with market trends in rent. So there's immediate opportunities there to come in and focus on optimizing income versus optimizing occupancy, right? And in that, for example, in our properties in Louisville and Lexington, excuse me, I mean, we've been able to come in and realize $100 to $150 to even $200 rent bumps on renovations because the properties are just sitting so far below the market. in those scenarios.
It does seem too. You've got places like Louisville, Lexington. I mean, now that people are we've got this sort of great reshuffle taking place. I mean, people they're sort of moving to these areas that have affordability, that are more affordable, right? And I just think that we're going to continue to sort of see that. It's just more of that exodus out of the inner cities and urban cores, and just people are just sort of spreading out again, right? I feel like that was happening. And then to your point, with a lot of where the jobs are coming from, because right now in that area, I believe I read the other day, I mean, there's 3 jobs for every like one person willing to work it, whereas in like on the coast it's like 1 for 1 or whatever. So here they're hiring, and just do the math. It's sort of like, well, I'm over here and I'm competing for these gigs, and it's really expensive to live here. Over there, I can choose. I've got a couple jobs to pick from, get in, and a lot of them are sort of that workforce. It's the workforce housing is the need, and like you said, they want people want a nice place to stay, and it's affordable. I just think it's going to continue.
That's exactly right. Well, that's exactly right. And I think it's important to say like that is our strategy. Our strategy is workforce housing, right? We're not buying Class A stuff downtown. We're buying properties where the median income of the people that live there is typically between about $40,000 to $60,000 a year, right? And they're largely renters by necessity versus by choice, right? People that are going to be long-term renters, maybe lifetime renters. And exactly right. They need a clean, affordable place to live. So it's very key to our analysis that we can maintain that level of affordability on those properties. So one of the key things that we look at when we go to acquire a property is that rent to income ratio. It's how much of the income of the people, how much of their income are they spending on rent? Right. And HUD defines someone as being rent burdened as having spending 30% or more of their income on rent on a monthly basis. So we like to find properties that are in the high teens to low 20s, right? A nice cushion up to that 30%, which means we can come in and we can make changes and we can raise rents and we can add value for our investors. But at the same time, we're still maintaining a nice level of affordability for those folks. And that means there's going to be high demand into that property. And, the one thing I would just say is like when you were describing why people would move to the Midwest, for example, because of jobs and because of the lack of competition. I mean, that's exactly why this is where I've chosen to invest, is because versus chasing everybody else to the hot markets, I mean, it's not necessarily a contrarian strategy, but it's a little bit of an alternate strategy and just going the other direction, right? If everybody else is going left, I want to go right. And if everybody else is saying you got to buy big properties, you can only buy big properties, well, I'm going to go below all them. And so lessening competition from geography, lessening competition from the unit size we're going at. And that gets back to allowing us to buy at a better value than if you're in an environment where it's not uncommon, like in Phoenix, Arizona, for example, to have 20 or 30 people bidding on one property. It's impossible to buy that property at the right price to ever really realize the return that you should without everything going perfect. Right? If everything goes perfect for the next 5 years, then I'm sure that investment will be a home run. But if you're banking your underwriting and your returns on a perfect scenario, that's thin. It's unlikely to occur. So I like to be in a position where we have a lot of contingencies in place in case things don't work out as everyone hopes they do.
Philosophy is we've always been big fans of the Midwest, and that's really where we've done all our multifamily investing: Kansas City, Indianapolis, Michigan, Ohio. The unfortunate Illinois investment, but that's another story. So yeah.
I used to live in Chicago, so I get it. I sold a condo there. It's hard to make money.
And it's unbelievable. It's everything that people tell you that it is,
Yes.
and so it is. There's just certain places that are better to transact and easier. But yeah, definitely also bullish on
That's right.
the Midwest. Yeah, I mean, you're not going to get the crazy appreciation or those things. But I mean, it cuts both ways, right? I mean, I call that volatility, and I could live without it.
But you know what though? I mean, we are seeing opportunities though, where, I mean, we're seeing year over year rent growth in these markets at 4 and 5%, even in markets that you wouldn't consider sexy, like Louisville or in Indianapolis, right? Like we're seeing those growth numbers. Now we're not basing our investments on projecting those continuing to go forward for the next 5 years,
That's right. Yeah,
but
and I
we're
think
seeing that
that's
kind of
what
growth happen
everyone's
right
sort of
now.
looking at, and this is where you can see that. I mean, the economy's all out of whack. I mean, we've got supply and demand imbalances everywhere you turn. It's crazy, and so I think and therefore you're seeing a lot of rent growth in places that one wouldn't, you wouldn't think that it would be that high, and and those things are great. And that's what I mean, but it's still, like you said, I mean, at the end of the day, it's all about, it's good quality real estate. You do the right thing. I mean, it just, and it gives you got a margin for error. Like you said, I mean, you're buying at 2 caps or 2.5 caps or 3 caps. I mean,
That's right.
Anything turns against you. I mean, you could lose the property. I mean, like, it's just bad things can happen. And that's super stressful, which I think leads to my question. I know you got some room for safety, but as an active investor now, as you're doing this, like, I mean, not even just that, but just for you, like, what is the thing that keeps you up at night? I mean, if something did keep you up at night, what is the thing when it comes to a transaction that you sort of, makes you the most nervous, right? Like, you're hey, I've done all this stuff, but really this is that thing that I don't control or can't control that just, that makes you nervous.
Yeah. Man, the thing that makes me most nervous long term is this merry-go-round we are on of money printing and just monetary supply, and the $9 trillion that have been pumped in the last however many months, and the X trillion on top of that in the past few years. Right now, from a real estate standpoint, it's great because there's so much money floating around. It's why asset appreciation is going crazy, right? And so that's great if you own and take advantage of that. But I'm an econ guy at heart. I was an economics guy in college, and I know that at some point that merry-go-round has to stop. And I don't know when it does. It could be 10, 15 years from now. Who knows? But I'm just concerned that's one thing that I'm concerned about, is kind of, how do we manage out of that, and how do we back off that?
It is. I mean, and I think that it's funny because, when you really go down that rabbit hole, I mean, real estate is a good place to sort of park some cash, right? I mean, in what will certainly be an inflationary environment, and for a bunch of those reasons. So it's sort of like, yes, it may impact it, in ways that we don't know, and clearly it has to. I mean, it's much of the supply and demand imbalances that we have now due to COVID and supply chain. And I mean, people were bringing them up. Of course, you can talk about it till you're blue in the face. When it happens to you and it hits you, you're like, well, I didn't see that specific thing coming. And they all have an effect and impact on one another. But yeah, I mean, I think that especially with multifamily real estate in particular, it's a good store of value, a good place to sort of put some money, right? And especially given that there's not enough of it around,
absolutely,
and not enough that's even permitted, or in most places there's not much of it being built.
Well, that's right. I mean, and you see that in single family house price appreciation as well, right? Just from a living standpoint, there's not enough places for people to live. And based on current construction trends, I mean, we're not catching up. So, like I said, I'm an econ guy at heart, and I like to keep things simple. And if you get rid of all the noise and just go back to supply and demand, if you're in an environment where demand is outpacing supply, you're going to see prices increase, right? That's just fundamentally how it works. And so, real estate is a great, like you said, store of value. It's a great inflationary hedge because as inflation increases, rent will also increase, and so you'll see your income increase on the property, and so it's a great hedge there. So, I mean, I believe it's a great place to be in most economic environments, and so again, I think that's one of the reasons why it's a good investment.
Exactly. Yeah, I mean, I think
why I spend so much time investing in it.
We're 5.5 million homes short, like. that's a lot of houses, right? And so
Yeah.
it just, those don't come online overnight. It's going to take years. And so, but yeah, that's good.
Right. Well, and the price of a starter home in the last 3 years has gone from 160,000 to over 200,000. So the affordability of these homes is outpacing more and more people, right? I mean, you see those studies where it says like most of the population couldn't handle a $400
Right.
hit,
Emergency.
right? They couldn't handle a
43% of
$400 car
Americans can't
car
deal with
bill
$500
or hospital bill or something,
emergency.
right? Yeah. Yeah, there you go. So in that environment, how many can put a 20% down payment down on a house? You know, as housing prices continue to escalate. I mean, in Indianapolis, housing prices went up 15% last year, and I think they're already outpacing that this year. So, you know, it's just putting. I think that's why rentals are so important. I think that's why we're going to become an even more nation of renters, is because, you know, there's just not that affordability that exists for people. People's wages, like when we talk about inflation over the past like 40 years, a lot of what we talk about is asset price inflation, right? Is housing prices going up, but commodities going up, multifamily properties going up. What we haven't seen is wage inflation, you know, and that's occurred because of globalization, right? People, corporations, instead of paying higher wages in the US, send jobs to all over the world, right? And so as asset appreciation continues to outpace wage appreciation, the affordability decreases, right? And therefore rentals become more and more important.
I'm most nervous about, right, is that missing middle class, those who aren't, they're above the poverty line.
Mm-hmm.
They're the ones who rent your apartments. They're the ones who can't, they can't deal with a $500 emergency expense. And I had on the show, well, it aired last week, but we had a whole series on that of just, we've got a client, Thrive FP, down in Austin, and, it's 8-10 years ago, they took that to heart and realized, like, hey, we're buying all this workforce housing, we can do more, to really help our residents and tenants with, after school care, and they offer them free, telehealth, and, just really trying to understand what, it's not just about the sparkly pool, right? It's like these people have other needs, right? And if we can help meet them, I mean, we can help change their lives and impact their lives while simultaneously having a lifelong tenant, which, allows us to make more money, right? And so we can do them both. And they started a nonprofit called Veritas Impact Partners out of Dallas, that does that now. And they offer that as a service to multifamily owners, right, to go out and really build that community within these apartment complexes and make sure that they're touching in and understanding what their needs are and how can they be of help. And I'm all for that. So that's sort of become our passion project, is just trying to get the word out to do those things. Awesome. Because everything we're talking about, those economics, are they're going to continue to squeeze that middle class even more than they already are. It's a big deal. I mean, homelessness is a big deal. Don't get me wrong, but
that's right.
Like, the amount of people that fit in this category, it's a staggering number. And so I'm with you. It's a big deal.
Yeah. Well, I 100% agree. And I mean, I grew up very blue collar. I mean, I would have fit in that category, growing up. And so I totally understand, the importance there. And I mean, we've been able to do some cool things as well, such as community gardens, language assistance programs for people with English as a second language. And I think those type of amenities are so much more important to folks, just to that demographic than, for example, having a pool, right? Or having a fitness center, right? I mean, I've seen stats where it's like only 10% of the people actually ever use those amenities. But those amenities that can really add tremendous value and make a stickiness on the property are those things that are improving the ability for the residents to be successful, right? Because if they're successful, then your property will be successful. And so I think that's a fantastic point of view.
Yeah, I agree. Cool. So, yeah, where can people learn more about what you guys are doing at Hudson Investing?
Yeah. So first of all, you can check out my own podcast. It's called Ritter on Real Estate, and it's really focused on how to be a better passive investor. Tagline is passively invest like a pro. You can find it anywhere you listen to podcasts. And then secondly, I'd say you can go to kentritter.com, and that's really my home base. You can check out more about me and find some tools and some information for investors. And you can also sign up for our newsletter or to be an investor with us.
Cool. Awesome. Well, I'm glad we were able to finally connect, Kent. Have a great day, man.
Thanks, Lance. This is a blast. Appreciate you having me on.
Yeah, you're welcome, man. Take care.